You should have a good reason behind every trade. Today I'm sharing several key points that you must add in your trading checklist. Use it every time you want to enter a trade, and you'll see a dramatic decrease in the amount of unforced errors that you make during the execution process. So, if you could, like, subscribe to the channel, and stick around for the full video. Market trends have a repeating pattern of a strong impulsive wave in the trending direction, then a smaller pullback against the impulsive wave, followed by another impulsive wave. Your job is to isolate the most recent strong impulsive wave to determine the trend. Also, you need to spot corrections in the trend, because these are the pullbacks that are going to provide an opportunity to enter into the trend direction. And you want to pull the trigger on a trade when there is enough evidence to suggest the pullback is ending and another impulse is beginning. So the first step is to know the dominant market trend. An uptrend occurs when the price movement is making higher swing lows and higher swing highs. This is telling you that the waves in the trending direction, what we call impulses, must be bigger than the corrections. If a correction is bigger than an impulse, it violates the higher swing low rule, thus the uptrend is in jeopardy. Downtrends occur when the price is making lower swing highs and lower swing lows. Therefore, the impulses to the downside must be larger than the corrections higher. If a correction is bigger than the last impulse, it violates the lower swing high rule. At all times, you must know in which direction the impulses are moving. During a correction, you must remind yourself that you only want to trade in the direction of the impulses. And don't let the pullback scare you. This is your opportunity to get into the next impulse, even though it feels like the price is moving against you. During a trend, you may have several periods of choppy price action as the price consolidates. This is normal, and you must still trust the trend. When the choppy price action persists for a longer period, it's better not to initiate new positions within that choppy area. Sit back and either wait for a better entry outside the choppy price action, or let the price begin to trend again before placing orders. Before placing a trade, it's important to identify key resistance and support lines, or supply and demand areas. Support levels or demand zones are areas at which the market had difficulties to break below, signaling that buyers may join the market again if the price falls to this key level. Resistance levels or supply areas are quite similar, only that they form to the upside and signal price levels at which the market had difficulties to break above. These key levels are like price magnets. The price is always moving towards them, and this presents a trading opportunity for you. You should rely on key chart levels to spot areas of previous buying and selling pressure. This is done by using horizontal lines, trend lines, round numbers, Fibonacci retracements, pivot points, or even some indicators to provide dynamic support or resistance. Moving averages and VWAP are perfect for this. So try to time your entry around those areas, because a good key level can turn the price. When price is near a key level, you'll have two trade scenarios: a key level bounce or a key level breakout. Very often, you'll find the price bouncing off the key levels. The price would approach a key level serving as a resistance, for example, hit the level, and bounce back in the direction it was initially coming from. Other times, you'll see price breaking through a key level, and in this case, you'll have a breakout trade. Nonetheless, regardless if you have a key bounce or a breakout, the lesson is simple: trade the key level only within the dominant trend. A trade trigger is a specific set of conditions within a certain context that tell you now is the time to act. Look for bullish signals at support levels and bearish signals at resistance levels. This is the key to finding the best trades in any trading strategy. Let's assume the trend is down. The waves to the downside are bigger than the corrections higher. The trade trigger is what tells you exactly when and where to get short, given the context. Trade triggers could include a simple bounce from a key level, candlestick patterns, chart patterns breakouts, a confirmation from an indicator, or any other precise occurrence which doesn't happen that often. But when it does, it tells you it's time to get into a trade. In this case, we have an engulfing candle and a divergence from one indicator. And don't fall into the trap of overcomplicating the analysis by adding multiple conditions for an entry. Keep the analysis and the entry trigger clean and simple. The same goes for long trades. Watch for higher highs and higher lows. As long as the corrections stay above the low of the prior corrections and price is approaching some important price level, watch for trade triggers. When a trade trigger occurs in the direction of the trend, you enter long. Here we have a double pin bar rejection, which shows bullish pressure in an uptrend at a support level. The entry point should be spelled out in a clear manner so as to avoid any ambiguity whenever possible. And one important note, your preferred entry point may not always occur. As such, you may need a backup plan in the form of an alternative entry trigger. This alternative entry can get you into a viable trade setup when your preferred entry point doesn't occur, so it doesn't hurt to have a plan B in mind. Price movements aren't always what they appear. Beneath the surface of a move higher or lower, trends may be forming or turning into a reversal, while swings in trading volume may not be enough on their own to reveal changes in a trend. They can give you a sense of how much strength there is behind a move. Look for above average or increasing trading volume, which can signal that traders are truly committed to a price move. Observe here how the price and volume are both increasing. Below average or decreasing volume can signal a lack of enthusiasm. During uptrends and even in sideways markets, price will occasionally run into a resistance level. When price breaks through that level, the breakout is generally believed to be more significant if volume is high or above average. A breakout followed by low volume suggests enthusiasm for the move may be lacking. Volume confirmation is also important for the entry trigger, so you need to start learning the basics of volume spread analysis. Volume spread analysis looks at candles and the volume per candle to determine price direction. It looks at the quantity of volume per candle, the range spread, and the closing price. So you must learn the most common VSA patterns, like the buying or selling climax, the no demand or no supply pattern, or the up thrust and the down thrust bar. This video will help you understand the VSA concepts. Don't make your trading decisions based on one single time frame. Try to employ a multiple time frame analysis to monitor a market under multiple time frame charts. You don't need to use 3 time frames, just use 2. You only need to be aware of the bigger picture. Usually, a higher time frame is used to identify the market context, while a lower time frame is used to spot ideal trading opportunities to enter the market. Thus, if there's a strong trend on a higher time frame, trading in the direction of that trend around the key level on the lower time frame will likely produce a higher probability of a winning trade. If one of the time frames is out of alignment, there is no trade. To focus on major support and resistance levels, you can find them on higher time frames before applying them to your trading time frame for analysis. For instance, you can note down the support and resistance levels from the daily chart, then plot them on the hourly one to find trading opportunities. This method keeps you focused on the important support and resistance levels. If you have conflicting information from higher time frames, you might want to skip the trade. You must be aware of the risk you will take on each trade and the reward you will receive prior to the trade execution. This means knowing where to place your stops and your profit target. A trade should only be placed when the anticipated gain or reward from the trade matches or exceeds the risk being taken. Assessing the risk factor is easy. You basically determine the portion of capital to be risked on each trade. A fixed percentage of your capital, for example 1 or 2% per trade, is decent. Based on this percentage, you determine the invalidation point of the trade, the point at which your assumption has been proven wrong. This is the location to place your stop-loss order. Assessing the reward is more challenging. A common method is using the next key support or resistance area, the closest level that you believe it could possibly hold price, resulting, in the worst case, in a bounce of that level, threatening the viability of your trade. Very important, the distance from the entry point to the first support and resistance area must arrive at an optimal risk-to-reward ratio for your trade. If it doesn't offer, you don't want to take that trade. Sudden market news have the potential to invalidate the perfect trade. Some releases are more important than others, and while it's almost impossible to anticipate how the markets will react, you must know the times at which various countries release important economic releases, like interest rate decisions, GDP releases, unemployment, and inflation announcements. Plan ahead by consulting an economic calendar which highlights major economic releases from the top trading nations. For example, if you spot an opportunity on the forex market, you find a decent trend, price is near a key level, you have the entry trigger, the volume and the higher timeframes confirm the setup, the risk-to-reward ratio is optimal. But in the next hour, there's a GDP release. It's better to wait until the numbers are out. Or, if you're in an open position, you may want to consider how close the market is to your stop or profit target prior to the news release. You don't have to be in perfect harmony with the economic calendar of events, but it's important to be aware if there are events taking place each day. These releases are often catalysts for profitable market moves, but can also provide unseen resistance and false signals. The reason so many traders fail is because they are always trying to be in a trade. First of all, the best trades are the ones that jump right at you. After looking at the chart for just a moment, you know what to do if you are dealing with a good trade. Trading is often referred to as a business of pattern recognition, and a trader who has taken hundreds of trades knows the difference between a high probability setup and one that just doesn't look right. If you are unsure about the potential setup, it's usually better to pass on that particular trade. If you are nervous or stressed, or you don't have much time to trade and monitor the position, if you are tired or you lack concentration and you are not in the proper mindset to trade, it's better to avoid trading for that day. When you find a setup that meets all your criteria, when it feels good internally, if you feel good mentally, if you are not frustrated about your past results, then you can pull the trigger. If you found value and learned something new, leave us a like. This way we'll know if you'd like to see more videos like this one. Picture this. You are right in the middle of a profitable trade, but you are nervous because you think price will reverse soon against you. Or you lost a trade and immediately after you enter another one, trying to recover the lost money. Or the price is almost hitting your stop loss and you decide to move it far away, hoping and praying for a break-even trade. If this is a common scenario for you, I have several solutions for these problems. Developing a strategy is the easy part in trading, but the mental aspect of trading is where most people struggle. Today we'll talk about that, the science behind profitable trading. So if you could, like, subscribe to the channel, and stick around for the full video. Trading is often a game of timing the market. The more timing is important to your system, the more important is to avoid pulling the trigger early on a trade. That ability to wait for the right moment, whether to wait for a pullback, or a completion of a price pattern, or a confirmation from an indicator, can mean the difference between success or failure in trading. Good trading is all about waiting. Waiting for the correct setup, waiting for the right entry, waiting for the trade to play out, waiting to exit a trade, and then waiting all over again to enter the next trade. If you can find that you can't wait and keep entering the trade too early, see if you can make some adjustments to your system, such as using price or pattern alerts, and implement a way of keeping yourself away from the charts for those minutes that would normally see you jumping in the trade too early. This technique is especially effective if you're swing trading and you're using the higher time frames. And remember that trading is all about playing the long game. It's important to associate waiting with good feelings, so you can feel good about waiting, and try to avoid the feeling that you should be doing something, because you'll soon start taking trades against your strategy. The more complex a system or series of filters in your strategy that determine whether a trade is valid, the more difficult trading becomes. The smaller the cognitive load you have to bear in order to take a trade, the clearer your mind will be, and the easier it will be to perform the action. Look at what you are really trying to achieve. Often, it's simply to find a low-risk way of entering the daily momentum to take out a piece of the market. The multitude of trading systems out there are mainly trying to do the same thing, which is to take a piece out of a strongly moving market. If that is the case, then the simplest way of doing this is going to be the easiest for you to implement. Keep your system as simple and streamlined as possible. So the trick is to make your strategy logical, simple but effective. If it makes sense, then you can consider it. If it doesn't make logical sense, get rid of it, and try to view the information with the correct perspective, rather than waiting for magical levels like overbought or oversold, without understanding the underlying logic of why that may occur. You want to focus on price and how the market reacts to that price, how much volume, how quickly it moves, how far it moves to get there. Consider these aspects logically, consider what it means, and then make your conclusions for what movements can happen next. If a trade is bad from the start, nothing you can do will help. It's best to exit the trade as soon as possible to avoid doing any further damage to your account. Unfortunately, traders can become attached to a trade and will hold it in the hope that it may turn itself around. The problem is that even if the trade did work out this time, you are setting a dangerous precedent for future trades. If it does come back and rewards you with profits, you will never learn that cutting your losses is the best route to go and can lead you to trading habits that will eventually destroy your account. Many traders see losses as threats, and they try everything to avoid a sure loss, even if it means gambling and possibly losing much more. Look at a simple but common example. The market has reached a level where, if it breaks it, a multitude of orders will flow into the market, and a missed exit could mean a far worse price if and when you decide to close out your position. So next time you find yourself in a trade that isn't working, don't wait in the hope that it will work out or start moving your stop loss further away. That money could be put to good use in other trade that would work out. Watching and worrying about the result of your trades after you have placed them can be counterproductive and leads to exiting too early and moving stops closer or further away. Basically, you are undoing the research that got you in the trade into the first place. It's best to let the market do its work. Here's my solution to reduce trading anxiety while you're in a trade. Each time I place a trade, I consider it lost from the beginning. When I hit the buy or sell button, in my mind, that trade is already lost. I accepted the losing outcome right from the start. This way, I know what to expect from the trade. I don't feel the urge to revenge trading, to constantly check the price, or to move away my stop loss. If the trade indeed turns out to be a loser, I was already mentally prepared. I already visualized my account balance being down 2%. And if the trade is successful, it's like receiving an unexpected gift. And trust me, it's better to be surprised than frustrated. So, before you place your trade, you need to have already determined that the money you risked on that trade is gone. When you have determined the risk capital in a trade and have already subtracted that amount from your balance, then there is very limited emotional response you should get from a loss. Rather than wasting time or losing sleep over things that you have no power over, what you can and should focus on is assessing probabilities. You should focus on finding opportunities and defining your risk prior to entry, because in the end, those are the only things you can control. I mean, you do realize that you don't have to be right each time you interact with the market. You don't even need to be correct 50% of the time to make money. Unfortunately, most traders, regardless of their experience level, are incapable of realizing this. Most choose to focus efforts on whether the next trade will be a winner or a loser. So what's the solution? Rather than looking at the outcome of a single trade by itself, view it as one outcome among a set of outcomes. You need to analyze your trading strategy and take into account different parameters. Trading expectancy, which is the average amount a trader can expect to win or lose using a particular system. The win-loss ratio, how many trades produced a winning reaction over how many concluded a loss. The risk-to-reward ratio, which is the average size of a profitable trade divided by a typical losing trade. If you understand that your trading system has a positive expectancy, a high probability of making money over the long term, you won't stress whether the next trade will be a winner or not. Most traders follow either an essentially objective or subjective trading style. Objective traders follow a set of rules to guide their trading decisions. They prefer to have buy or sell decisions essentially pre-planned. In contrast, subjective traders adapt to changing market conditions and base their trading decisions more on their judgment regarding a specific trading opportunity. Subjective traders are usually more vulnerable to being guided by emotion rather than reason in their trading decisions. My advice to you is to try to eliminate subjectivity from your trading approach, especially if you are a new trader in your first years. It's a good way to reduce your emotional involvement. Objective trading can also be referred to as rule-based trading. You follow a clearly defined set of rules for entry, exit, time frame, and markets. It's pretty much a matter of just entering, letting the trade play out, either hitting the profit target or being taken out by a stop loss. This trading approach may also have rules for adjusting profit targets or stop orders based on the market action. However, as an objective trader, you'll usually be much less active in this regard than a subjective trader. Due to the relative simplicity of objective trading, it's ideal for new traders who lack the skill and experience required for complex market analysis. A set of rules to guide both trade entries and exits can lower the stress level and the psychological pressure that novice traders may naturally feel. Ever been afraid to pull the trigger on a trade or felt afraid to trade altogether? This is basically trading anxiety, and it affects all traders at some point. You know the feeling. When you see a trade, it's a perfect setup for your system. You have confirmed it exactly as you should. but you are hesitating to pull the trigger. This trading anxiety comes from the lack of trading confidence. And this happens when you don't have confidence in your trading skills. Perhaps you have no enough trading knowledge, or you don't have a stable trading plan or a decent strategy to help you ease your trading stress. If you relate to this, you need to develop a confident trading mindset. The longer you trade with patience and discipline, the more it will pay off. If you consistently trade day by day, strictly following your trading plan, you will soon develop positive trading habits, which one day will evolve into sound trading confidence. And of course, success is the key element which drives confidence. There are no better arguments that can make you feel really confident than a winning trade, or even better, a series of winning trades. So even if you close a trade with little profit, even a break-even trade, that's still a win. You didn't lose money and you learned something. Another way to build confidence is to keep track of your winning and losing trades. And again, don't get obsessed with the outcome of any single trade. Instead, put your energy into consistent and disciplined trading practice, which will eventually teach you to avoid mistakes. We tend to hold too many expectations for ourselves. We stress because we want the markets to behave in a certain way. You probably have seen a lot of stories of traders who turned $1,000 into $1 million within a year. You've seen traders telling you that you can quit your full-time job and start trading for a living. The problem is that many traders are chasing unrealistic returns, 50% per week, 10% per day. A lot of people who are attracted to trading are part of a get-rich-quick crowd. And there's nothing wrong with wanting to get rich quick. But the fact is, quick in trading rarely means 1 year. You need to accept the fact that you will not be making a lot of money while trading in the beginning. So no, you will not be quitting your job to trade full-time. Do it as a side business in your first years, even if you are profitable. For those reasons, it's vital that you make sure you align your expectations with your general trading approach. You can make money trading, but only by being patient, setting realistic goals, and taking your time. This is the safest route, and it will not happen overnight. If you found value and learned something new, leave us a like. This way we'll know if you'd like to see more videos like this one. And check out our Academy program if you want to further level up your trading. Until next time. You can be the most knowledgeable person at the trading desk, but if you don't know how to handle yourself when you press the buy and sell button, you're going to be an average trader at best. Unfortunately, few people know how to actually handle their emotions when trading. In today's video, we'll talk about the most common mistakes you are probably making on a daily basis, and I'll showcase the actual steps I took to become more disciplined and more patient. So, like, subscribe, and stick around for the full video. Here's an exercise which will massively improve your discipline. Open a demo account and blow it intentionally. Make all of your trading mistakes on that demo account, because you first need to make them in order to learn not to repeat them. You basically get your trading mistakes out of your system. So open your demo account and go nuts. Make all the mistakes you know. Chasing a position, over trading having large positions, lose a trade and then open a second one to recover the losses, trade without stop losses. Blow your demo account, then open another one and repeat the same mistakes. Observe your mistakes, but also be aware of your feelings. Try to visualize that mistake on a live account and be grateful this is only a demo account. This exercise helped me to become more disciplined. It's weird, but it works. Learning how to trade correctly and eliminate mistakes is about doing something that's hard until it becomes easy. Making mistakes and failing means you are working through the hard parts. But the key point of this exercise is to remember your emotions, your state of mind, when you make a certain mistake. If you are doing it correctly, it will prevent you from repeating the same mistake on a live account. This sounds like a cliché, but you actually learn a ton from bad trades, specifically from reviewing them. I suggest you take a screenshot of the chart of a bad trade. Go back and look at it several days or weeks later. You'll look at it and say, what the hell was I thinking? Why did I enter here? In the end, screen time, practice, and education will make you capable of finding good trades, but learning to avoid the bad trades will make you profitable. Here's one of my own past struggles. I had an inclination to wait on a losing trade with the hope of getting out at break-even, but I used to take my profits very quickly because I got very anxious when I was in profit. It was very frustrating. Do you see the paradox? I was being too risk-averse when it came to profit-taking. I wasn't able to contain my emotions when in profit, but I was risk-seeking when it came to loss-taking. I have invested an excessive amount of time and energy watching losing positions than watching winning trades. You know the famous saying that 90% of traders are losers. But here's the reality. Most losing traders are not really consistent losers. They are instead blowing up their accounts on one bad trade. They don't slowly lose the funds in their account, trade by trade. In fact, they are making profits or preserve their capital at first. What ends their trading accounts is one bad trade, one stubborn trade, where they don't accept a small loss. You might be amazed, but most traders are blowing up their accounts on just a few bad trades, and this can be avoided 100%. It's easy to be overwhelmed if you load yourself up. Too many markets to keep track of, too many strategies to backtest. You need to narrow it down. I remember when I first started trading Forex, I used to have a template with over 20 currencies, and I woke up every morning and manually placed the support and resistance levels on each pair before the London Open, and I tried to monitor them simultaneously. And you know the outcome. Many missed trades, which resulted in many poor trades taken out of frustration. You have a lot of things to cover: market selection and preparation, pattern recognition, risk to reward, indicators, volume, position size, entry level, price action, trade management. It's easy to become overwhelmed. So when day trading, focus on fewer things at one time. Even though the price will go up or down, you don't need to trade every moment. There is enough money to be made trading only a few times each day. You don't need to sit in front of the screen all day. I spend an hour, maximum 2 every day, researching and trading, or maybe even less. But you must decide what works for you. You only need a few good trades a week to be profitable. I know that there's a tendency to try to squeeze every dollar out of the trading day, but when you have reached your profit target or you stop seeing setups, stop trading. When you realize this, you won't have the need to get into a trade, any trade, not to miss out on the profit. This reduces risk, losses, and trading commissions. After several similar mistakes, I now have a simple rule when I'm day trading. I must close my positions at the end of the day, even at a loss. You should never turn a day trade into a swing trade and hold it overnight. You know the feeling. you open a trade hoping for a quick profit, and instead of closing it, you find yourself justifying staying in a bad trade the second day. This is one of the deadliest sins a day trader can make. You need to change your mindset. Think about it. You can always get back in, but it's hard to recover from a big loss. You may think, I don't want to take a $100 loss. Well, you definitely don't want to take a $300 loss. And if you end up taking a $500 loss, it would be really hard to recover from that. Again, never turn a day trade into a swing trade. Take the loss and come back when the timing is better. In my first years, I used to average down on losing trades. Imagine you buy 10 shares of a company at $100 in anticipation of selling them at around $110. Instead, the stock breaks the support level and drops to $80. You have lost the trade and you should have been stopped out. But instead of accepting the loss and moving on, you buy another 10 shares at $80. And now you have 20 shares at an average cost of $90. It's unlikely the price will hit your initial target of $110, but now you're hoping that price will rally back to $90. Because at $90, you can sell all of your 20 shares at break-even and save the previous losing trade. Even better, if the price goes to $95, you can even record some profits. It's very tempting to average down on a losing trade with the hope of getting out at break-even, but you shouldn't do it. Averaging down a losing trade is a recipe for wiping out your account. 90% of time, maybe you'll profit when you average down, but the 10% of time you are wrong, you will blow your account. I've done it, and I still remember the frustration and the anger. Every day you hope that price will turn around and will save your account. It's a waste of mental energy, and I don't want to feel those emotions ever again. Fear of missing out is perhaps the deadliest of all trading sins that you can make. This is wishful thinking, and it can be a very costly trading mistake to jump into a trade before a pattern has either formed or been confirmed. It can also be a very costly trading mistake to chase a pattern that is visible but is not offering a good risk-to-reward opportunity. Although FOMO is very dangerous, it's actually very easy to avoid it. You just need to ask yourself one simple question before entering any trade. What is my risk-to-reward ratio in this trade? If you cannot identify a good risk-to-reward, it is a fear of missing out trade, and you should not take it. If you cannot determine a stop-loss or profit target, then it's a trade based on FOMO, and you shouldn't take it. When we talk about FOMO, we also talk about greed. If you see that the market is moving toward the weekly high with heavy volume, breaks the level, you might take a position, even though this wasn't your initial plan. And there is nothing wrong with that. It's not greed or FOMO, because you saw a clear signal of opportunity to take a position. But if you take a position because you saw a YouTube video saying that Bitcoin is going to the moon, or a Reddit post that said that it's time to buy a random stock and there's significant money to be made, then you are trading based on FOMO. You have to be able to make the difference between a FOMO trade and a trade which maybe wasn't in your initial plan, but it's backed by your technicals. Fear can be triggered, for example, by your concerns over your profitability and your account. If you are afraid to take a trade because you are too focused on the fact that your $5,000 account is now at $4,000 and you had 5 bad trading days in a row. This is not a mindset to have. Your previous losses have nothing to do with the trade you are about to enter. If you are concerned that the price action is not clean, or that the volume in the trade is not enough, or that you don't have a confirmation, that's okay. Those concerns are not based on fear. But if your concern over another loss is based on a bad trading day the week before, that is a disruptive fear. You have to realize that your current trade idea has absolutely nothing to do with how you have traded in the previous days. If instead of responding to the market, you are reacting to your own concerns regarding your profit, you are acting in fear, and this will take you out of the current reality of the market. Instead, you will be acting based upon your own uncertainties and insecurities. Whenever you fear pulling the trigger, try to find out why are you afraid. Is it because of the price action, or is it because of your own insecurities? Dealing with losses and failures on a daily basis can be difficult because no setup is perfect and every setup is unique. Even winning days are full of small mistakes and things that could be improved. In many other areas of life, perfection is a worthy goal, but not so with trading. I'm a perfectionist, and this is still one of my main struggles in trading. As a perfectionist, you're used to think inside a box rather than outside of it. As a trader, feeling uncomfortable is your new comfort zone. You must see what others don't. You test new ideas, new strategies, you seize new opportunities, and you take risks. This requires courage and the ability to keep going despite daily losses. It's very important to understand the risk and the probabilities involved in trading. Think of trading as a business that operates based on probabilities. The market is a random environment. Anything can happen at any moment. Having this understanding is the key to peaceful trading. A trader's career is based on probability and statistics. If you learn to trade proper risk-reward trades, you trade defensive, and you always use a stop loss, in the long term, you will make more money than you will lose. If you found value and learned something new, leave us a like. This way we'll know if you'd like to see more videos like this one.